The most powerful brand in Chinese sports isn't the one you expect. It's ANTA Group, China's #1 sportswear leader ahead of Li-Ning, Adidas and Nike. Behind the names, it's not one brand. It's a platform of 5 core brands in China, and together they run approximately 12,000 points of sale across China. In this video, we'll break down what ANTA actually does, how the business makes money, the financials, and I will finish with my personal view on the stock. Let's start with where this all came from. ANTA began in Jinjiang in 1991, listed in Hong Kong in 2007, and made its first defining move in 2009 by taking over FILA's Greater China business, acquiring the franchise and PRC trademark rights for mainland China, Hong Kong and Macau from Best GV at the time, when the operation was still loss-making. The next phase was about building a real multi-brand platform, a joint venture for Descente in 2016, Kolon Sports in 2017, and then a step change in 2019. ANTA led the LBO of Amer Sports, bringing Teryx, Salomon and Wilson into the family. Fast forward to 2024, Amer Sports listed on the NYSE. ANTA is the scale engine. Performance footwear and apparel for everyday athletes, runners, students, weekend hoopers. Priced entry to mid-tier, but increasingly justified by in-house foams, plates and signature basketball lines. In 2024, ANTA was roughly half of group revenue, with a gross margin in the mid-50s%, strong for mass and hybrid channel, more DTC every year, still some franchise for reach, spread across approximately 7,100 ANTA and 2,800 ANTA Kids stores nationwide. FILA is the premium athleisure. Sport DNA with fashion credibility, big in women's wear and kids, and a curated retail experience. It contributed just under 40% of group revenue in 2024 at high 60s% gross margin, which is elite by industry standards and a key driver of group mix. Price positioning is mid to premium, apparel led with footwear rising, sold mostly through self-operated boutiques, 1,260 FILA Plus, 590 FILA Kids Fusion doors across China. Descente is the technical performance pillar. Ski, training, triathlon, golf, anchor the premium materials, patterning and fit. It sits firmly premium on price, with high ASPs supported by technical outerwear and performance fabrics. While its revenue is part of the overbrands bucket, the segment that reached low 70s gross margin in 2024, the brand's footprint is compact and focused. 226 doors, driving image, not ubiquity. Kolon Sports covers outdoor lifestyle. Shell jackets, insulation, trail and city outdoor. Positioned mid-premium to premium for urban consumers who want function that looks good in the city. Like Descente, it sits inside the overbrand's pillar that carries low 70s% gross margin. The network is tight, 191 stores, and built for storytelling, not saturation. Think everyday outdoor becoming mainstream in big city China. MAIA Active is the women's yoga athleisure entry. Mid to premium pricing, smaller today but strategically important to round out the female segment. It lives mostly in DTC retail and digital, adds depth to lifestyle bottoms and tops, and complements FILA women. Amer is the premium outdoor accelerator in top of the China platform. Teryx, hyper-premium technical apparel, Salomon, trail, run, ski, Wilson, racket and team sports. For China, it creates a halo effect and unlocks high-end demand. For operations, it brings global DTC merchandising know-how back into the group. Corporate mechanics matter. Amer was taken private via an LBO in 2019 and listed on the NYSE in 2024. New shares raised cash to pay down debt, which modestly diluted ANTA's percentage stake, but control remained with ANTA. And the brands now have a stronger balance sheet to grow. Ownership shorthand, 52.7% pre-IPO, 43.3% post-IPO, and 39.5% after the December 2024 primary. The group owns other brands too, but we have highlighted the most important ones. Now, a quick recap. Now, quick read on the top line, because the scale of the engine explains a lot of what comes next. Revenue grew from 8.9 billion RMB in 2014 to 70.8 billion RMB in 2024, about 8x in 10 years, 23% CAGR. The EV to revenue spike in 2020, approximately 7.8x, was simply post-COVID demand and DTC hype pushing the share price much faster than sales. Since then, the share price has deflated, and the multiple has normalized to 3.6x, low to mid versus the past decade, and far below the 2020 blow-off. In H1 2025, revenue reached 38.5 billion RMB, plus 14.3% year-on-year. By segment, ANTA 14.2 billion RMB, plus 8.6%, FILA 16.9 billion RMB, plus 26.3%, other brands 7.4 billion RMB, plus 0.6%. Margins tell you how that revenue turns into profit. Gross margin rose from 45% in 2014 to 62% in 2024, up almost every year, driven by a richer mix, more DTC omni-control, product ASP upgrades, and scale sourcing efficiencies. Even with heavier promos in 2022, the group stayed above 60% and re-expanded in 2023-2024. Then, step down one level to operating economics. Think of EBITDA margin as gross margin minus operating costs. Store staff, rent, leases, marketing, logistics, HQ. Through the cycle, ANTA has run in the low to mid 20s. It spiked close to 30% in 2019-2020 on mix and scale, then normalized to 25-26% in 2024 as DTC-driven retail costs ramped. Let's talk input and the cost base, because that's what keeps margins resilient. Like every sportswear company, the bill of materials is cotton, polyester nylon blends, EVA PU rubber compounds, and trims. Those prices move, but for ANTA, the bigger levers are not raw materials. The real weight is people, retail, and brand. In 2024, staff costs sat in the mid-teens as a percentage of revenue. Advertising and promotion were around 9%, and R&D was roughly 2 to 3%. That's the economic logic of this sector. High gross margins fund talent, stores, and brand equity. Materials matter, but they are not the first thing that breaks the P&L. Finally, the outlook. Demand is structurally rising. Health and outdoor are mainstreaming. Performance categories like running and trail are still underpenetrated. And with ANTA's brand leader and DTC reach, my base case is approximately 10% annual growth over the next few years. On top of that, state support for sports, from national fitness programs to school and community facilities, keeps widening participation, which should underpin that growth pace. Now let's see how it translates into the numbers, starting with EPS. EPS went from 0.68 RMB in 2014 to 5.55 RMB in 2024, approximately 8.2x in a decade. 2024 benefits from the Amer dilution gain. Backing that out gives a clean EPS of 4.25 RMB. Using the normalized 2024 EPS, that implies approximately 20% CAGR over the past decade, slightly below revenue because the share count rose from 2.6 billion in 2014 to 2.8 billion in 2024, roughly plus 5 to 7%. Otherwise, exceptional for sportswear. In H1 2025, EPS was 2.53 RMB, minus 8% year-on-year, mainly because last year's Amer IPO dilution gain wasn't repeated. On a clean basis, ex-Amer effects, underlying profit rose 7%. ANTA is asset-light. PP per share 1.7 RMB in 2024, a tiny slice of the share price, consistent with leased retail and outsourced manufacturing. Market cap to tangible equity has compressed from 12.4x in 2020 to 3.54x in 2024 now, i.e., investors pay 4 yuan for each yuan of hard equity today versus 12 yuan at the peak. ANTA's balance sheet has been lightly levered for a decade. The 2024 blip is refinancing plus working capital, not stress. Borrowings rose to 20.8 billion RMB, net debt 9.4 billion RMB. After issuing 1.5 billion euros, 0% 2029 convertibles to retire most 2025 notes and increasing supplier bills payable while bank loans fell. if fully converted at the reset price, approximately 101 Hong Kong dollar, the notes would add 121 million shares, about 4% potential dilution. Bottom line, maturity is extended, liquidity intact, leverage still low. CapEx remains modest for an asset-light retailers, about 3.5 billion RMB in 2024, 5% of sales, a step up versus 2020-2023, but still low. Its store refurbishments, omni logistics, and digital rather than new factories. So expect CapEx to hover in the low to mid single-digit percentage of revenue. Shift to DTC Premium lifted the cash cycle from 39 days in 2014 to a 109-day peak in 2022. Discipline and faster allocation brought it down to 93 days in 2024. Expect it to stay above early 2010s levels, but gradually easing with ongoing inventory control. Free cash flow has trended up over the decade, rising from 0.6 RMB per share in 2014 to 4.7 RMB per share in 2024, with a peak around 6.6 RMB per share in 2023. The 2024 step down reflects higher CapEx, store DTC upgrades, and the working capital rebuild after the growth spurt. At today's price to free cash flow is approximately 18 to 19x, mid to high teens, well below 2020's spike, and reasonable if free cash flow keeps compounding double digits. Shareholder return has been steady and rising, with DPS moving from 0.61 Hong Kong dollar in 2014 to 2.36 Hong Kong dollar in 2024, and a 50% payout since 2021. That's relatively high for a company still in growth mode. Good for yield, 2.5%, but it tightens the reinvestment buffer if the group wants to push faster expansion. ANTA approved a 10 billion Hong Kong dollar repurchase program, 18-month window announced August 2024. That's approximately 4% of today's market cap, which corresponds to the potential dilution from the convertible bonds. Today's price is 94 Hong Kong dollar, almost exactly the -1 sigma band. On reported financial year 2024 EPS, 5.55 RMB, the stock trades at approximately 15.4x PE. Using normalized financial year 2024 EPS ex Amer gain and swapping H1 25 for H1 24, we get a clean TTM EPS approximately 4.59 RMB, implying a PE of 18.7x. As a cross-check, a two-stage free cash flow to equity DCF indicates approximately 127 Hong Kong dollar per share, slightly below the 146 Hong Kong dollar regression line. ANTA isn't one logo, it's a platform. Multiple brands at different price points spread risk and let the group steer its mix as taste shift. A nationwide store network makes distribution hard to copy, and a tight DTC data loop shortens reaction time, keeps inventory turning, and supports premium pricing, especially in outdoor, kids, and women's. But there are limits. Heritage is shallower than Nike or Adidas, so brand equity must be rebuilt continuously with product and marketing. Technology can be matched, which puts the pressure on execution. The payout is generous for a growth name, which can cap flexibility when new opportunities open up. On valuation, the stock sits near the -1 sigma regression band and on my clean run rate trades around 18.7x P. Not cheap, not stretched. Reasonable for a scaled operator with a premium mix and disciplined execution. Bottom line, China's middle class is expanding and sport outdoor adoption is rising, so the runway is long. If ANTA keeps executing the multi-brand, DTC, premium mix playbook, the shares look slightly undervalued at today's price. Thanks for watching this deep dive until the end. If you found this analysis useful, feel free to like, subscribe and share. And if you are into consumer brands, check out my leaning breakdown next, the perfect counterpoint to see how China's other homegrown champion stacks up.